Hello, and welcome to Option Pricing in Greeks 105. In this section, we're going to go through the answers to questions 13 to 15. Now, these questions are talking about hedging, where an investor would buy puts, maybe a put spread because it's a cheaper hedge. And in the last part, we're going to be having a put spread and finance. We're going to go to the Apple security, and we're going to bring in the OVME function, as you've seen many times before. In these questions, we're just dealing with the puts and the calls. This, of course, in the real world would be overlaid with a stock position or stock positions, a portfolio. But for simplicity, we're going to look at the options side of it. Now, let's create the first of the three deals. This one is my call. I'm going to leave it as a buy as I create the deal, but when I come to my portfolio, I'm going to be selling this position. So leave it as a buy as I set it up. It has a 105 strike. It has a 25 forecast vol. The interest rates are 1%. The dividend yield is 0%. Now, I get to a price of 3.05 because I'm doing this earlier in the morning at 9:29, and the option expiry is 16:30, and Bloomberg prices its options to the minute. So if I were to say put this at midday, you'll see now that it does have a price of 304 because I just cut off some of its life, and 304 would be the price that somebody who in the afternoon were coming into OVME would get if they were creating this deal in the afternoon, because indeed from the afternoon to the defaulted expiry of 16:30 they would have got to 304. Okay, this is my first deal. I'm going to save it. I'm going to give it a name of Call 105 because that's where the strike is. Save. And I can find this deal again in future using the code plus CALL105. I'm going to create a second deal now. This second deal is going to be a put. The second deal has a strike of 100. Again, the rate of 1, dividends of 0, the volatility of 24%, and that gets me to a price of 4.64. Okay. Now, if I did update, I would overwrite this strike and put on that label. So I'm not going to do that. I'm going to say Actions, Save Deal As, and I'm going to give this one a label of Put 100. This is just a description, but I'm going to change it, instead of being AC for American Call, American Put 100. That was just text. I've now created a deal called Plus PUT 100 Equity. Finally, I'm going to create my 95 put, which has a value of forecasted volatility on this is higher because it's further out of the money. Remember, the further out of the money you get for both puts and calls, generally speaking, the higher the volatility level. So with the 26 forecast vol, this has a value of 2.83 for that put. I will now save this put, Actions, Save Deal As, and this is my put 95. And again, I will change AP. It's not 100. It's going to be 95. So I have the three deals saved. Now, straight away, I'm going to type OSA as a shortcut to get me not only into the option scenario analysis function, but it will open with the last option deal I had showing on the screen, which was the 95 put. So that position is already in place. 90 days to expiry, it's a 95 put. Up here is a box that says Add Position. So I'm now going to add. The plus is part of the code. The plus doesn't mean add in a position, it just means that's part of the code. It's called the it's called the plus PUT 100. I'm going to hit my yellow F8 equity key, and now I'm going to hit the green go key, and you can see I've also introduced and included the put 100. Now I'm going to show you an alternative way, positions, add OVME deals. Remember, we saved this as an OVME deal. I'm going to click on the call 105. I'm going to add deals. And now you see I have all 3 deals showing. Now, the 95 put was sold. That was part of the put spread. And it was sold at a level of 2.83. That was the cost price. The 100 put, the beginning of the put spread, was bought, and it was bought at a price of 4.64. The 105 call was sold to finance the situation, and that was sold at 3.04. Okay, now, because the underlying right now is trading at 94.86, which is different to 100, the market prices of these options will be different to the cost price. That's because of the delta and gamma associated. Furthermore, because we're looking at the implied volatility from the marketplace, there will also be a Vega component that makes these market prices different from my cost prices. Just have a quick look in your head that you're happy that when the share price is lower, this call is trading at a lower level, but this put is trading at a higher level. You should be comfortable with that concept. Now, first part of the question, what is the cost of the strategy? Well, I paid $464 buying the 100 put. I received $283 for selling the 95 put, but then I also received $304 for selling the call. So overall, I received money for putting the strategy on. I received $123. Okay? Sounds too good to be true? Well, you'll see in a moment why it isn't quite so good to be true. But right now, the cost of the strategy is you receiving money, you receiving a credit of $123, and that's because of the risks and obligations that you have taken on. You'll see those presently. What is the break-even level of the strategy? Now, we're going to go straight to the scenario chart. We're going to switch off the expiries, which are prior to expiry. These will be very useful in later exercises, but right now I'm going to switch them off. And I'm just leaving the 18th of August expiry, as you can see. I'm going to tighten up the range to make it easier to visualize, 90 to 110. Notice this x-axis is exactly what I want it to be. It is the underlying price. The y-axis is exactly what I want it to be. It's the P&L, and it's versus my cost prices. So this is the profile that I was expecting. You will see here you have a put spread, but the put spread, instead of taking place mostly below the 0 P&L line, is above, and that's because by selling this 10 strike call, we've pushed up the whole of the put spread, giving us this $123 credit for putting the strategy on, but the break-even level is essentially that $123 more than the 105 strike, so $106.23 is where the break-even level is. So that's the 105 strike plus $1.23, the credit for putting the strategy on. The break-even level is 106.23. Okay. Now, just by the by, because Apple is trading at 95 while I set up this trade, the bulk of the profit is appearing above the line. Ordinarily, the put spread would be taking place straddling where the current shares are, and if you imagine, instead of the break-even line being here, it would probably be put on with a break-even line around here. Okay, but for academic purposes, this is working just fine. Now, what's the maximum profit of this strategy? Well, as we go lower and lower, the put spread is making us more and more money here between 100 and 95, but at 95, the second put kicks in and we no longer make any money, but the maximum profit is the $5 between the strikes that we made, or magnified by 100 is 500, and then the 123 we got for putting the trade on, so 623 is the maximum profit of the trade. Maximum loss of the strategy? Well, as the underlying rallies and we get further, the stocks go higher and higher, the line is getting lower and lower, so the loss is getting bigger and bigger. The maximum loss of this strategy is unlimited. It's as high as the stock goes because of that short call. At what underlying price does the maximum profit occur? Well, it's from $95 strike downwards, the maximum profit occurs. And at what underlying price does the maximum loss occur? Well, that's a trick question. The highest price that Apple can go to is where the maximum loss will be. So if you like, that's infinity. Okay, so that's all of the parts to question 13 answered. Now, question 14. How does the above maximum profit compare to just the put? So what we'll do now is we will switch off this call and we'll go back to just a put spread. Watch this chart as I take the calls off. And now you are left with just a put spread. So how does the above maximum profit compare to just the put spread? Well, here we didn't get the 123 for putting the strategy on, so essentially this maximum profit has just dropped by the 120. Excuse me, we didn't get the 283 for selling the call, so this maximum profit has become lower. So this is what it was before, 623 minus the 283. So that gets us down to, where are we? 52. This gets us down to the 320 level there. The next part of the question is just a put. So here I'm taking away that short put and I'm left with just a long 90 put, and you can see that the maximum profit on the long 90 put again is going to be one of these maximum profits which is almost unlimited. It's the lower the stock goes, the higher the profit is. I mean, there is a theoretical maximum profit. It's when the share price goes to zero, that's where you'll get the maximum profit. Next part of the question, how do the break-even levels compare? Now, this is very important because with the put on its own, you see the break-even level is all the way over here at 95.36, and that's because it's the 100 strike, take away the 464 cost. So my point is it's all the way to the left of the 100, the break-even level, before this strategy has given you any reward. When we add back the short put to make it into a put spread, the reason why investors do this is because now, although we won't get as much profit from this put spread, you see that break-even level has moved all the way over to the right, and we've now got a break-even level, in the $98.20 range, which is, again, it's the $100 take away the cost of the put spread. Finally, when we sell the 100 call to finance the trade as well, the break-even level moves even further to the right. It moves another $3.04 to the right, because that's what we received for selling the calls. So we came from a break-even level of here to a break-even level of here, and now with that extra sale, we've got a break-even level all the way over here. But to have a break-even level that means we're making our hedge works more quickly, with the break-even levels to the right, it means we will be losing money if the stock rallies and we didn't need the hedge at all. So this is very least would be called an aggressive hedge. A pure hedge might only hedge the downside and not cost you money if the stock goes up. This is quite an aggressive hedging strategy. Okay, that answers question 13, 14 and 15. Thank you.